Hi, today on Level Up, we will be discussing rising interest rates and its impact on property prices. The recent 0.75 percentage hike in Fed funds rate raised concerns on how high interest rates will rise and its impact on the economy and property prices. In order for us to address that, let's take a look at the interest rate cycle. Fed funds rates are typically capped at a sweet spot above 2% in a healthy economy. Looking back at historical data in 2006, Fed funds rates peaked at 5.25%, leading up to the global financial crisis, where the US property market was heating up and players in the market were giving out cheap credits to subprime borrowers. Fed funds rates dropped to almost zero in 2008, and quantitative easing started for the first time in the aftermath of the global financial crisis, and interest rates were kept at zero up till 2015. It only started to increase in 2016, reaching a high of 2.4%, and the 3-month SIBOR and SORA at 2.01% and 1.72% respectively before COVID hit. Between 2020 to 2021, interest rates once again dropped to almost zero and quantitative easing was reintroduced. This inevitably led to inflation accelerating as the economy went into recovery. And at present in 2022, there is currently a lot of fear about excessive inflation and expected interest rate levels. However, looking at the bigger picture, although we are transitioning from a low interest rate environment, we can see that interest rates at present are just normalizing to the pre-pandemic levels as part of the next interest rate cycle. As there are significant negative effects of excessively raising interest rates, policymakers cannot keep raising interest rates. An excessive rise in interest rates would result in homeowners facing increasingly more trouble servicing their mortgage loans. There is also a limit on the effectiveness of hiking interest rates to solve all inflation problems, such as cost-push inflation caused by global supply chain shocks due to the war in Ukraine. The Russia-Ukraine war led to surging prices of energy and agriculture products as global supply chains are disrupted. Raising interest rates would not address the root cause of cost-push inflation, as these supply chain issues are separate. So looking at the interest rate situation in Singapore and how it relates to property prices, even if Fed increased interest rates to 3.4% based on year-end estimates, analysis of historical data comparing the SORA and Fed fund rates show that hikes in the Fed fund rates will result in a less than proportional increase in the SORA. Previous peaks in US interest rates in 2006 to 2007 and 2019 saw similar trends in Singapore rates at a smaller scale. So looking at the interest rate situation in Singapore and how it relates to property prices, even if Fed increases interest rates to 3.4% based on year-end estimates, analysis of historical data comparing the SORA and Fed fund rates show that hikes in the Fed fund rates will result in a less than proportional increase in the SORA rates. Previous peaks in US interest rates in 2006 to 2007 and 2019 saw similar trends in Singapore rates at a smaller scale. While interest rates are a factor in property prices, there are also many other factors affecting property prices. Firstly, we expect property prices to remain resilient due to Singapore's property cooling measures. The total debt servicing ratio of 55%, based on the interest rate stress test of 3.5%, ensure that home buyers purchase within their affordability and have the holding power to withstand crisis and rising interest rate environment such as the one we are in today. This means your housing loan repayments, after adding all your repayment obligations such as credit card loans, car loans, personal loans, etc., cannot exceed 55% of your income. Home buyers must maintain a TDSR of 55% or under, even if interest rates were to rise to 3.5%. For example, for a household income of $10,000, their debt obligations cannot exceed $5,500 based on 55% TDSR. If they are looking to purchase a home worth $1.35 million, their mortgage will be $4,546 based on 3.5% interest rate stress test. Assuming they have a car loan at $500 per month, it brings their total debt obligations to $5,046, which fulfills the TDSR criteria of 55% and below. Not only would home buyers have holding power, but the high rental environment also helps to cushion the interest rates increase. Therefore, we expect property prices to remain resilient even with the interest rate hike. Secondly, demand and supply. Looking at the supply of unsold new launch units, the unsold stock fell to 14,087 units in Q1 2022, signaling a low supply ahead. At the same time, the average number of units sold per year in the last 10 years from 2011 to 2020 is 11,503 units, while a 20-year average from 2001 to 2020 is 10,559 units. In 2021 alone, 13,027 units were sold. Hence, we expect these unsold units to be absorbed in a matter of 1 to 1.5 years. In addition, we anticipate more HDB and 𝗖𝗍 upgraders entering the private property market as they fulfill their minimum occupation period this year. Apart from this local demand, we see more PRs and foreigners entering the market in 2022, making up a larger percentage of home buyers as compared to the previous years, as Singapore proved to be a desirable safe haven for assets through the COVID pandemic and war. With the low supply and strong demand from upgraders and foreigners, we anticipate property prices to continue increasing. Next, property prices are projected to rise due to increased land and construction costs. Government land sale prices have increased over the years, leading to increased property prices. For example, in the outside central region, in 2017, the average PSF PPR was $707, increasing by 19.4% to $844 PSF PPR, and then increasing by 33.5% to 1,217 PSF PPR in 2021-2022, with sites like Ang Mo Kio Avenue 1 and Lentor. This is also seen in rest of central region, with the average PSF PPR increase from $867 to $1,302. Looking at the low unsold supply, developers have no choice but to bid aggressively for land to replenish their land bank, and therefore property prices will increase with this increased land cost. Supply disruptions from the Russia-Ukraine war and ongoing supply chain issues will cause prices of core construction materials in Singapore such as copper, steel, concrete, cement and bricks to remain elevated in the next few quarters. These increased building costs will also cause property prices to increase. In summary, these are the key takeaways. Interest rate hikes are part of a normalization process to regulate inflation in an interest rate cycle, and policymakers will not keep increasing as excessive hikes can have severe negative impact on the economy. In these instances, it will be good to lock in a fixed rate package early in a rising interest rate environment. For SORA packages, historical interest rates increase have shown to increase at a smaller scale and lagging behind the Fed interest rate hikes. At the same time, private property prices are expected to remain resilient due to strong holding power of homeowners from cooling measures put in place. Prices are expected to increase due to dwindling supply, high demand, increased land and construction costs. With property prices expected to remain resilient and increase, it is also important to look at the bigger picture and not just one factor, interest rates, when making a decision on buying a property to avoid being priced out. By waiting out, we would also be left with a shorter loan tenure, and increased property prices would eventually place pressure on affordability, causing home buyers to be priced out when it comes to size, location and type of property. We hope you had some useful takeaways from today's Level Up episode. If you would like a more in-depth tailored consult on property matters, do reach out to us and we'll see you in our next episode.